Okay. Tom, how's it going?
Yes, good, thanks, mate. You?
Yeah, I'm doing good, thank you. Been looking forward to this stream. So today it's all things macro, isn't it?
Yeah, we can dive into it.
Yeah, well, it's been a big week so far. We've had the chaos with the tariffs, we had Nvidia earnings coming out, and there's a lot going on. We have escalations between Iran and the US. So why don't you get us up to speed with the main narratives right now that are shaping macro?
So so we're still watching the jobs data, labor market data, sorry, jobs data, inflation data. But ultimately it's looking like inflation is trending down, but at very slow progress. The jobs market is hanging in there and is showing it's it's showing there's some weakness underneath the surface, like at the headline level, it's not as good as the numbers are sort of showing. But ultimately, the situation is that the market is priced for two cuts this year, but for them not to happen anytime soon. So you're talking June for the first cut. We think there'll be three cuts because of some labour market weakness potentially to come through the year. But that's like rumbling in the background. That's something we're paying attention to, but it is not on the agenda for right now, essentially. In terms of what's on the agenda for right now, we had Nvidia last night. Their earnings were very good, and I think the market is taking that as a bit of a bad signal today. To be honest, obviously you've got the US Iran negotiations going on today as well, and that will come out, sort of now going into tomorrow. But essentially, looking at the Nvidia earnings, they're very, very good. They essentially beat, but the stock price wasn't rewarded, and it's potentially showing this sort of lack of enthusiasm that maybe the AI trade has not run its course, but markets can get ahead of where the technology is, and possibly it's at the point where it needs a bit of a pullback before it can then have another leg in, say, 6 months, 9 months time, whatever. And you're seeing this rotation from big Mag 7 big tech stocks, AI into more sort of harder assets. But Bitcoin doesn't trade like gold. The correlation sort of broke down mid late last year when you first started seeing gold go up. I think it broke out past 4,000, and Bitcoin then just kept lagging. It didn't really move. So I think that correlation is more broken down, and Bitcoin is mostly trading now. Previously, we've always had gold would consolidate, then move, and Bitcoin would go up during the consolidation and then stagnate or consolidate during gold's move higher. We sort of don't have that now. Bitcoin just does trade like a risk on asset, and it's obviously traded more heavily. I think that's due to a number of things, like quantum, the threat of quantum, for instance. But once price comes down to, and I think you're at that level now where price is coming down to a bit more of an attractive level where investors are starting to step in. The guys that think, that have bigger money, they will start to get positioned here, but they will want to see some sort of solution on the quantum threat this year, because it will take 2 to 3 years to implement, and quantum computers is expected to be able to potentially go in and steal the Satoshi coins or whatever in the next sort of 3 to 7 years, somewhere in that time frame. So we're running it a little bit tight, and I think that's what's keeping some of the big money on the side at the moment. But that big money will dip in if price becomes attractive enough.
Yes, for sure, absolutely. I think the idea that Bitcoin is gold 2.0 and it's going to trade like gold and it's a hedge against inflation. I think we've seen over the last year or so that's been completely thrown out of whack. I think the ETF played a big part in that, where it just started to be traded way more like an equity. And I think attention is on the AI stocks, as we went over a couple of times. But it is very interesting to see the correlation between equities and Bitcoin right now. Before tapping into the relationship. Look, Bitcoin went to what, $126,000. It's at what, 66,000 right now. That's nearly 50% down. I think we touched 60 at one point earlier in the month. This is a bear market, right? I know that sounds like a silly question, but a lot of people are just calling it a dip. But this is a bear market.
I would say this is a bear market, and I do think this bull market was different to prior bulls, so I do think this bear market will be different to prior bears. I don't see any like systemic risk that was maybe the quantum threat does become that, but there was systemic risk in the past with a lot of the big players sort of crashing out, and then obviously that was hit hardest in late 2022 with FTX dropping, um, or going bankrupt, losing people's money, etc. So I don't know if that's something like stuff like that is going to happen this time. It's very possible it does, but I think it's just going to be on the DAT side, and it's going to be the DATs that are then. I think we had one of the first go over the other day, sell their Bitcoin, but very small size. There's only actually a few of the DATs that have big enough size that if they sold, it would really sort of move the price. So and price has come down relatively quickly. It's close to these key on chain levels that are in these sort of mid 50Ks. Anything like I think the electoral cost is 50,600 at this moment. I think you have realized price at 55,000, 200 week moving average at 58. So there's lots of like key on chain cost levels in there. Now, I've been asked, is this the bottom in? Is this not the bottom in? All prior bear markets have tested the realized price. So, and that's currently 56. So, and I think just because we bounced from 60 to say 70 again, we're still, in all honesty, we're still just in the range. And I think Bitcoin's now in the 66s. So I think I'm not sure. I wouldn't let yesterday's move from 63 to 69, 70. It's one day's price action. That's all I would say for now. It's one day's price action. I'd say it's a bear market, but I do think it'll be different to other bears. I don't think it's going to be this prolonged 2-year bear market that we're used to.
Yeah, absolutely. It just seems like from a macro perspective, yes, we're in a bear market, like 3, 4 months in, you can't deny it. But the macro backdrop seems relatively healthy, and I just can't
Yeah.
see throughout 2026, the whole of it, us staying down. How far through the bear market do you think we are? We midway? We near the end? We in the early stages? What's your take from a macro perspective?
Um. So from the liquidity point of view, there's a lot of liquidity metrics that are like the N2, for instance, that keeps going higher. But just looking at some of the stuff that we look at internally, and then looking at others that we consider like experts in that field. Obviously, can't be an expert in every field. We have to go to the people we consider the experts in certain field, whether it be labor market data, inflation, liquidity metrics. It looks as if liquidity did peak in Q4 of last year. Um, so that's usually not great for financial assets. And to be honest, since then, the indexes, and you look at like big tech, for instance, have mostly, look at the indexes. The indexes have been sort of sideways. Look at the Nasdaq, it's been sideways for the last 4 or 5 months, which would sort of be in line with that. So usually, what we've had in terms of Bitcoin crypto is we've had an aggressive move down over like 4 to 6 months, and then we've had a period of chop of 4 to 6 months. Now, I think we're at the very beginning. So February was the move down to 60K was the first point of the chop. And I think we've had the price pain, and now I think we're going to get the time pain. And I think price will probably range. I think it can range anywhere between like mid 50, 55K, so mid 50Ks, and like 76K. It could, so even if we was to break out, and we're back down to 66s, but I had people texting me today when they saw price at 69 and stuff this morning. But I think even if we were to break out to like a 73, 74, 75, I wouldn't necessarily be like, bang, we're back to the races. And if you look back at prior bear markets, you have the price pain, and then you have the long time pain. And I think there's that big period of chopping around. And I think that's what we're in now. And I wouldn't usually, it's very rare to get the V reversals back up. And we're not going to get that unless we see an excess liquidity, which doesn't look likely in this immediate term. So I think you've got to look at the situation of what's actually playing out and say we're more likely to go down the chop solidation route.
That makes a lot of sense. And you've mentioned a couple of key levels. You mentioned the
Yeah.
cost basis levels. Could we go in and look at each of those independently and maybe explain why they're so important? You mentioned electricity costs as well. So obviously that has a big part when it comes to the miners. So yeah, can we look at a few of those and go into more detail?
Yeah. So let me. So there's a few that there's two just overview ones that I would use. Let's move that away. Sorry, I have the list of stuff there. Um, so there's two I would use. I would use, and these are sort of more top down structure, if you like. So I would look at the. I can share my screen just here. So this is the first I would share. Can you see this?
Yes.
So this is by Capriol Charles Edwards, who's very good on chain, and they create a lot of the sort of quantitative statistical models. This is one that is it's just been very good. If I look at it on the weekly, it's just a bit more zoomed out on the screen. So if you look here at the electrical cost, electrical cost is now down to 49. So it's very possible if price gets anywhere near this electrical cost, you just buy it. Like, just that's a real throw the kitchen sink at it. I don't know how well you can see this because it's a difficult chart. But essentially, look, if you get a touch of the electrical cost, you just buy it. Even if the electrical cost is moving over, you buy it. The only time we've got a big move down through the electrical cost, this red line at the bottom, was March 2020, which is COVID, which is here. And it was just a great buy. Historically, in bear markets, a move below the production cost, which is currently 61, has also been a good buy. Now, we did get a wick into it back over here, and it was a good buy for the time. But as you can see, like back here and back here, you had these rolling over of the band, and then a flattening of the band, which is sort of this did go sort of up from there. But here you had a flattening of the band. I don't see why here you don't have a rolling over now, and we've started to like bottom out here. You can see it's come round and curved over. I don't see why we can't have a chop in here, that band be there, and then we fill into that band. That's essentially what I would look at as the plan for there. Let me show another. So in short, that band is made up of the electrical cost at the bottom and the production cost at the top. The top part of that band is the production cost, which is 61, and the bottom part of that band is the electrical cost, which is 49. So it's a really big space, between 49 and 61. You're talking almost like 30% space, but again, you don't expect it to touch the electrical cost at 49. So if you get anywhere close to that, you should be taking it. I'm trying to actually prepare a model that shows how good the returns are, the forward returns, for when price comes within 10% of its electrical cost, but it's taken me a long time to get the data. So this is one.
Okay. No, very interesting. And Tom, how has electricity costs been impacted with the whole AI boom?
Well, you've seen a lot of the miners switch. So they've gone from mining Bitcoin because it's less profitable, or was more profitable, and they've now moved out to not mining Bitcoin and moved across to AI because mining Bitcoin is just isn't as profitable as what it was, or it's been harder to compete against other miners essentially. So I think it's also AI, just generally speaking, like it works. Like, I use crypto every day as well in terms of sending money, trading, all that kind of stuff. I use the apps. But there's a few people that I do know that have been in crypto. They don't use the crypto apps every day, but they do use Grok, ChatGPT, Claude. They do use the AI every day. So, and I think maybe the AI has just taken a little bit of the limelight.
Well, it's definitely taken the limelight, absolutely.
Yeah.
But I was just curious. Everyone seems to talk about how much energy AI takes to operate. So I was curious if that had a big impact on the cost for mining Bitcoin. And yeah.
I don't think it impacts directly the cost of mining Bitcoin. I think they just need the compute for AI. So I don't think it's I don't think the two are relevant of each other.
Okay, interesting for sure. And there was another metric you wanted to show us?
Yeah, I'll show you now. So this one, let me get the zoom correct. Okay, this is probably okay. So again, this should be relatively simple. Can you see?
Yes, I can see this.
Cool. So this is made up of just again, this is pretty simple top down in terms of on chain data and playing around on chain. There's so many other metrics that we'll dive into that then sort of could help us fill out this story a lot more in terms of what it's showing us or telling us behind the scenes of what's going on, which is how we can then look at realized losses, unrealized losses to work out how stressful the move down was to 60K at the beginning of the month in terms of was it real capitulation, was it not? And obviously that's what we put in the updates previously. But essentially here, what you're looking at is so 2017 bull, 2020 and 2021 bull, and then this last 2024, 2025. So bull, bull, bull. As you can see, the price usually gets into this upper green band, which is going to be the MVRV plus one or the vaulted price. We didn't get that in 2025. We sort of had we didn't have any euphoria in 2025. We had it in 2024 on maybe some of the real risk on stuff like altcoins, meme coins. But in later in 2025, we didn't seem to get it, even though it all seemed very geared towards getting that, especially when you saw gold break out as well. But it just didn't really come in Q4 2025. We just didn't really get it. But ultimately, if you look at let me take away some of these to make this cleaner as well. Okay. Sorry. So we'll keep these.
See, Tom, you know every single one of the ones that you find relevant, which you're highlighting. Could
Yeah.
you give like maybe a one sentence explanation of why they're important? So the 200-day moving average, the true mean price. Could you just give like a one sentence explanation for why each one
So
is important?
these two are quite self-explanatory. This is the average cost base of all short-term holder coins. This is the average cost basis, which is the green line of all long-term holder cost basis coins. So all the coins that are considered older than 155 days, which is long-term holders, that at the last price they moved at, what's the average of that? And that's that green line. The same for short-term holder cost basis, but that's for any coins that are below or are less than 155 days old. It's just I'm not really sure why it's 155 days, but I think the main on-chain analysts have come up with 155 days as it's quite a good gauge between dictating or signaling a shift from should be short-term holder to long-term holder. Realized price is the cost of all coins, so the average cost of all coins. And true mean price, I've forgotten this one, but it's sorry, I've forgotten the true mean. I can go back through it and add the definition later. But essentially, the true mean price has been the sort of last line in the sand for bull markets. So if price is holding above the true mean price, it's possibly a pullback that then could go on and run up again. When prices break below true mean price, it's usually the signal that we might be going into a bear market. You should be very wary. But the true mean price was at 81K when it first broke down. It's now at 78.
Yeah.
The realized price is the main one. So you have realized price at 54 now, 54.6. As you can see in prior bears, it's always been tested. Price went well below the long-term hold cost basis and the realized price. The same story here in 2022. So with realized price at 54, I find it'd be very unique for price to, in this bear market, say, to not go and retest the realized price. In all the prior ones, it's fallen well below. You're talking 20% below. So it'd be very peculiar for it not to go and at least test the realized price, which is currently at 54K. And it's turning over, which doesn't mean it's going to come down, because these don't necessarily come down. They just sort of flatline a little bit. But this is at 54K now. You also have to add in, when I showed the prior chart, the production cost and electrical cost. Production cost is at 61. There's, in bears, we always get well below production cost. So there's no reason why we shouldn't go below 5 to 10% below the production cost, which is currently, as I showed on the last chart, 61K. So that would put you at 55. So that's why I think the market aligns at this 55K level quite nicely. And that would be outperforming compared to prior bears. As you can see in prior bears, we went below the realized price and the long-term holder cost basis. And it was March 2020 where you actually touched the electrical cost. Now, we didn't do that here, and we didn't do that here, but we got close. We got within sort of 10% of it. That would have to be at 49K. So if that's at 49K and current price is at 66, say, then there's a long way down from there, essentially. Not that I think that price will touch the electrical cost at 49K,
Mhm.
but I think that's your bottom band. But you have to be eyeing the realized price at 55. It also matches with the 200-week moving average just above it.
That makes a lot of sense. So you are able to use some of these models to kind of gauge where the bottom may be. And obviously, I think a lot of people know, we've kind of put the range of 50 to 58 for the bottom at Cryptonary. Is that correct?
Yes, it's possible that you want to, for instance, the prior low is at 60K, so there's no reason why you can't have a few tests of 60K. So there's no reason why you can't then go and start DCAing at that level as well. Even slightly north of that, if you want to be ultra safe and you don't mind, okay, if we think the complete bottom would be like a 49K, that would be really extreme. Then you say, okay, if I get it at 60K, I'm risking 19, 18%, whatever that works out to be as your downside from 60 to 49. Also, if you wanted to get in slightly higher and be a bit safer at 62 to 49, you might be then looking at 20%, whatever it is. So 21%.
Yeah.
So if that's what you're comfortable risking, then that's relatively that's still somewhat safe. And I think most people have taken, or most retail participants, market participants would be quite comfortable in crypto taking a 20% drawdown. So that's 60K, even anything from sort of 50, mid to low 50s to very low 60, 61, 62. But again, don't target. The approach I would take is not to personally, or I don't personally try to buy a price, the bottom price, because you'll just never get it. You'll
Mm.
certainly never get your size in at the bottom. If I take you back to 2022 and you had the chance to buy 23, 21, 19, 22, 18, 20, all of a sudden, if those are like your pool of buys, they looked great 2.5 years later. So again, if price is going to go to 53 as an absolute bottom or 55 as an absolute bottom, and you get a fill at 61, 58, 59, 60, 57, and you're 5 to 10% above the absolute bottom price, you've probably done very well. And you're probably going to give yourself a 200% upside over the next 18 to 24 months if Bitcoin is then to get to 160, say.
Yep, that makes a lot of sense. And I suppose by doing that and putting these kind of layered orders, it gives us security if we are incorrect. So I believe it was back in April, we thought it was just a small relief bounce and we ended up
Yeah,
running all the way to all-time highs. By getting in now, slow and steady, you're hedging yourself against that.
yeah.
However, Tom, in both directions, in us not heading that low, and or we smash way below, let's say, the 49K mark, what would be the invalidations of our thesis in either direction? What would make you say, you know what, we're not going that low again, or we could get smashed and go lower?
Um, I think if you're going to go below 49K, quantum is the problem. I'd be very surprised if it was anything else that brought you below that level. And to be honest, I think you're still buying it. It sounds a bit terrible from a risk management perspective, but I think you look at those charts I show you there, and then you would say historically that would be a just phenomenal entry. Um, so I think if you are offered that, it's the case of, well, Bitcoin is then either going to be hacked by quantum and it's going to be dead in the doldrums for the next decade, and it's all going to zero anyway. So whether you buy at 60K is worthwhile against 49K, it's sort of the same thing. But if you are to get offered 49K or below 49K, and it's not a quantum threat, or there's a path forward to solving the quantum issues, then it's just a stonewall buy. In terms of the upside, I think a lot of the metrics have to change. I think you have to see like liquidity metrics improve. I think you have to see inflows into the space improve. I think there has to be a big sort of solution to the quantum threat and a strongly
Okay, I think Tom dropped out. Hopefully we can get him back in. In the meantime, oh, he's back. Tom, you're back. Can you say something?
Yeah, can you hear me?
Yeah, loud and clear.
Ah, it's the camera. Okay. Um, yeah, sorry. So it's sorry to the upside. I think it can hit certain price levels. Um, it can hit certain price levels, but mid 70s, even 80. But I think in terms of like being bullish, going on the downside on like 110k, 107k, it's because the outflows are bad. Long term holders were selling. There was a pause on the macro front, i.e., a pause on the rate cuts. Liquidity looked to be sort of stalling, at least not increasing at the pace you wanted to see it increase at. That was the story that you then think, okay, this is not accommodative for higher prices, which is then what sort of we said. Then led us to risk off. I think even if prices to go higher now, which is very possible because you could get this bit of relief because there just has, we have been pretty straight down,
Mhm.
but we were range bound between 86 and 95k or 94k for a while, and then price broke out to 97k again. It's a good move. We got that move right as well. Price broke out to 97k and then rolled over again. So I think there's no reason why we couldn't have a 63k to 70k move to 73, 74 to then roll back into the range and just form that range that we've seen in prior bear markets. Um, Essentially, you need to see the story, the underlying narrative of and what the picture, what the data is telling us, which is those big inflows into the ETFs, long-term holders buying a quantum solution and a sort of new accommodative policy in terms of the rate cuts, which I do think we'll get, but I just don't think it's going to cut. I think it's going to be June time that they come.
Yeah, that makes sense. So is that what you're foreseeing for how long we stay range bound? Let's say up until June, once there's been a hopefully healthy transfer of power with the Fed situation, and hopefully we see increases in liquidity. Is that what you're seeing up until June, range bound, pretty much?
Well, I think the market will price it in beforehand. I think so. I mean, Warsh has still got to get voted in first. He's still got to get approved.
Mm.
But I think he's dovish on rates and hawkish on the balance sheet. I think he'll be able to be dovish on rates, but I don't think he'll be able to be. I don't think he'll be able to make much progress on reducing the balance sheet, especially between now and the midterms. I'd be very surprised if Trump doesn't try to do something in terms of like checks in some form, like not so much like COVID like stimmy checks, but he did it with the military. I think it was a month or so ago with like $1,700 stimmy checks to the military guys. And I think he needs to win the midterms, and I do think he'll go for it. Um, so yeah, that's I think just because you might get the first cut in June, maybe July, June, and it's still if you see the labour market weakening, it might be the case that Powell ends up doing a cut. Like Powell might not be done with cuts just yet.
Mhm.
But the market will get a feel for that a month or two before, probably. So even if it is going to be June at the latest, you're probably going to see it in sort of April, May time. So that gives you the rest of February, March, maybe some of April. So I think it's in that time that you're then building that position. Prices come down to the low 60s, high 50s, maybe even mid 50s, and you're just clipping every time it goes into that area. Again, you're not trying to put all your stack in at the bottom price. You're just trying to buy that bottoming area.
Yeah, that makes a lot of sense, Tom. And you touched on Kevin Warsh for a second. You did mention he's been nominated, but he is yet to take power. Let's talk about him for a little minute. When he was nominated, I believe Bitcoin pulled back quite a little bit. I think it was around 6 to 10%. And then what we saw from there is mixed signals because when it comes from a speech perspective, he's always spoken very positively about Bitcoin. He said he sees it as gold 2.0. As you said, people consider him quite dovish in regards to rate cuts. As you said, yes, he has sounded a little, he sounded the opposite. He sounded a bit hawkish when it came to the balance sheet. So, what's the play here? If he's a dovish Fed chair, why did Bitcoin pull back? And what is the main concern with him?
So it's because his prior is hawkish. He was, I mean, coming out to the 2008 financial crisis, and the labor market was, unemployment rate was really moving higher. I think inflation was at like 0.8%, and he basically said that, we shouldn't be too accommodative because we should be wary of the inflation risk, which is obviously just a bit mental. Like, you're going into a real recession, and he's like worried about inflation rather than cutting rates and helping out the labor market. But again, that's 15 or so years ago. He can change his stance over a 15-year period, obviously. So I think the market was looking that he's been hawkish before, so they think, oh, he's going to be hawkish now. But it's just a poor reaction from the market, really. And I think that's been traded out now. Trump would not have hired a hawk. He's going to hire someone
Yeah.
who's dovish, someone he knows, who he's like close to, and there's like family ties with his, I believe it's his father-in-law, between the Trump family and Kevin Warsh's father-in-law. So I think he wants someone that's close to him, because, and he's even said he made a mistake not hiring or not nominating Kevin Warsh when he gave Powell the role, or nominated Powell for the role. So, and obviously Powell sort of got the job, and then has not gone against Trump, but just not done what Trump's needed to do, even though Powell has done the right stuff. So yeah, he'll be dovish. Trump would not have got him in if he was going to be a hawk.
Yeah, that makes sense. Absolutely. It just seems very, very interesting in the sense of, you're right. It doesn't make sense for Trump to pull him in if he thought he was going to be hawkish. And of course, he said positive things about Bitcoin. If the market really is looking at his prior actions and they're allowing that to skew their judgment, that's surprising to me. It doesn't make too much sense. It seems very, very emotional that they're making these decisions. But he did call quantitative easing an addiction, and he
Yeah.
does want to tighten the balance sheet. So, can you perhaps explain to someone who's a bit newer to macro how, in one sense, reducing interest rates increases liquidity, but if he's anti quantitative easing and he's positive quantitative tightening, or perhaps even just reducing the amount of easing, that restricts liquidity in the opposite direction, correct? So perhaps go off on a little tangent there, Tom tangent, and expand into that.
So he's right. You don't need QE. They won't do QE. QE is needed when you're in a bad financial, a real recession, a depression almost. That's when you need QE to really stimulate growth. We don't need to stimulate growth, and you're not going to do QE when the interest rate is at 3.5, 3.75%. You bring the interest rate down to zero first, make the cost of borrowing money cheap or nothing at 0%. QE is like the far end of the curve. For instance, if we need to do QE, or if the Fed need to go and do QE, something really bad has happened before we get to that. So, you want to be out of the market, hope for something bad to happen, and then QE to happen. But really, the QE comes, later. You need something really bad to happen first. So I think what's happened is we've seen stuff in terms of making the reserves ample enough in the money market funds. That's just essentially to bring the repo rates down and stop them from spiking, so that those money markets can function. That's all that's really happened. But you see some takes on Twitter with some people on Twitter saying that's QE. It's still 100% not QE. So yeah, I wouldn't really worry too much about QE. We don't expect it to come back anytime soon. You need a real financial recession for QE to then follow. So you shouldn't be hoping for QE, especially if you're holding assets. Yeah. So if you're thinking about QE, don't just don't worry about it.
Yeah, that makes sense. Oh, I hear some static. That makes a lot of sense, Tom. It seems that the market is placing a big uncertainty premium right now, when it comes to a bunch of things, but I guess, the Fed situation being one of them. But that pretty much addresses the Fed and liquidity. I enjoyed the on-chain metrics you went over. Let's take a pivot. Let's talk about some of the other interesting things going on. Can you tell us more about what's happening between Iran and the US? Because as we said, the market hates uncertainty. And when these things happen, crypto gets hit the hardest. And you talked about QE and reasonings for QE. And look, we saw with COVID, when you have like a world shattering event, typically this requires stimulus. And I'm not sure if what's happening between the US and Iran is just posturing, with them moving, a lot of military over to that region. But what are the likelihoods we see a kickoff? And then how will that affect the market when the first strike lands, if it happens? What will happen to the charts? And then longer term, is this just an excuse to eventually provide stimulus?
No, it's not an excuse for
Okay.
stimulus. I don't think it's. Okay, so if strikes happen from, and there's rumors that the US want the Israelis to strike Iran first, for then the US to then step in, because it's not like politically popular for the US to go to war with Iran, for instance. Um, Markets would come down like drastically. It'd be very, very risk off. Gold would get a bid, and it'd be the only thing that probably would get a bid. You'd probably get bonds would also get a bid. But it would be real risk off for equity markets. And I think this is potentially another reason why equity markets are struggling to break out, because there's this just like overhanging uncertainty. And you have to remember, in terms of like a military buildup, it's the biggest military buildup we've seen
Yeah.
from the US since the 2003 invasion of Iraq. So I think I think something will happen. I don't know if it's going to happen now or anytime soon, even though they're like, there's real confrontations and tensions at the moment in terms of doing a deal, and the Iranians don't seem to want to move on their sort of uranium enrichment. I think Trump is going to China, I think, in a month or two, and I don't know if
Okay.
he's going to want to. So the Chinese get a considerable amount of their oil from the Iranians, so I don't think that Trump is going to want to upset that before he goes to China. I think once he comes back from China, then he might not mind. He might not care too much to then go and upset that. But the real blow to Trump, other than obviously killing troops and all that, but in terms of like markets and stuff, the real blow would be closing the Strait of Hormuz, because that's where a ton of the oil comes out. I think it's 20-24% of the world's oil comes out the Strait of Hormuz each day. So if Iran was to close that strait, inflation would go considerably higher. There would be no rate cuts anytime soon, and it would be the case of opening up, and it could be the case of opening up that strait to then work out like, when is this thing going to clear? And markets would be very risk off until that strait is then reopened, or signs that it's going to reopen again. If you were to get something like that, in terms of both sides attacking each other, bombing each other, let the dust settle a little bit, but you want to be buying that in anticipation that the strait will be reopened again and the world will get back to everyday life.
Yeah, that makes a lot of sense. And I suppose it's also why you don't want to just full port at 55K, because you just don't know what's coming next. So that makes a lot of sense. I'm not sure what the current poly market odds are on a strike happening, but how much of this is already being priced in, where it's almost buy the rumor, sell the news, instead of, we're waiting for a potential strike to happen, or we're waiting for them to close the Strait of Hormuz. How much of it is already being priced in, which is why we're at where we are right now? Because what else explained just how wild things went with gold and how Bitcoin got obliterated so much? It's
Well,
almost like people were preparing for this inevitability.
gold has the other narrative as well, which is the central bank buying in central banks around the world are buying it in a de-risk away, or a move away from US assets, treasuries. And the big catalyst for that was the Ukraine Russia war, and then the Americans seized the Russian assets on the SWIFT system. The diabolical move, because there's just not the trust again in your debt anymore. So that was honestly what sort of kicked it all off. I think that's what started it. And now you're seeing the Chinese really try to move more towards gold rather than US treasuries, for instance. In terms of, so I think gold is slightly different, but again, geopolitical tensions do not help. Geopolitical tensions only aid gold at this point, and keep helping it sort of drive higher. The main one I would look at, and this is what I've been looking at, posted in the update the other day, is oil, is Brent crude. Today, for instance, because you've had conversations, negotiations, whatever you want to call it, in Geneva between the Iranians and the US, and it's said that both sides are still very far apart in a deal. Um, the Iranians aren't willing to do any sort of talking about the uranium enrichment. So I think, and that's a sort of, that's the thing that the US are going there for. And you can see that they're rebuilding their nuclear bases that the Trump administration bombed. I think it was last June it was.
Yeah.
So they're rebuilding all that. So they're only moving in that direction, regardless of what they want to say. I think the main one to watch in terms of is this going to happen, is this not going to happen, is Brent crude. And just today, off the back of these negotiations, Brent crude came down because I think the Trump administration came out, said that they're looking to do a deal, etc. And the Iranians also said similarly. And Brent crude came down from a few days ago at 72.5 down to 69 today, but it's now back at highs at 72.5 off the back of these negotiations, potentially not going that smoothly. So that's the real one to watch. If you start seeing Brent crude really start to break out, then something's going to happen. But again, Trump does not want this. So I think even though he might be getting all the military build up in the area, the feeling is he wants to do a strike, but he doesn't want to do the strike because of the repercussions on oil, what it then means for winning the midterms, cutting rates because inflation's gone up, etc. So I think he himself as the individual wants to go and do it, but he can't do it for his political career. Oil is the one to watch.
Yeah, no, it's very interesting. We took questions before the live stream, and one of them that got a lot of reactions was, how can one even assess Trump? He wants a strong market, and there's a lot of political tension in the US. The midterms are incredibly important, yet he's almost taking every action people don't want him to take. I believe it's less than 20% of Americans are in favor of
Yeah.
striking Iran. Regardless of their effectiveness, we've seen the tension regarding the tariffs as of late. I'll let you explain what went down there too, but it seems he's doing every single thing people don't want him to do. And I'm almost trying to understand, like, is he right and we're all crazy? And give it 3 months and his master plan has come to fruition and the markets are running and people are richer, inflation's under control, the job market's under control. What is going on? It's like he's his own worst enemy. But yeah.
I think all the stuff is actually quite good. Like the tariffs is good for the bond market because it brings the fiscal deficits back in slightly. So, that allows them to sell more of the debt that they need to sell. For instance, if you take away the tariffs, then it becomes harder for Besant to go and sell the coupons, the debt that the US needs. So I think tariffs are actually a good thing. Again, the issue is he's up for vote in November. So if this was a 5-year
Yeah.
plan, I think he'd be sweet. But that was Trump's.
Keep going,
but
Tom.
if he was able to do this over 5 years, I think he'd be sweet. But again, it takes time. Sometimes you have to have that bit of pain before you see the upside. But the issue is he's the midterms, and he's just going to he won't be voted out, of course, but he'll lose the midterms. He won't be able to get much done and get much through. So that's essentially the issue. In terms of the tariffs, I think he's fine on tariffs in terms of getting them on, because you asked about that. He now using section 122 and section 301. He can, and again, I don't think section 122 or 301 have bin used for tariffs before, but he has 150 days to go and put these tariffs on, which is what he's done. It was 10%, then later that day he put it up to 15%, and then Monday morning I think he put it back down to 10%. So there's like confusion about what the actual rate is. So again, that's just a Trump market, I suppose. But I think he wants to get it to the 15%, and he's probably going to do that. And in this 150-day window that they have these sort of global tariffs on, that they're calling it, they'll look for other means to go and get these tariffs on. So they're staying. I wouldn't worry too much about the tariff situation, and it's not good for the American consumer or the American businesses really. But it's bringing money in the door, revenue in the door for the US, which is helping out their fiscal situation.
Yeah, no, that makes sense. If you had to give a very simple kind of explanation of the relationship between Bitcoin's price, because we don't really care about gold or equities, to be honest, um, tariffs up, what does that do in the immediate term? How does the market react, Bitcoin in particular? And then look, they're up now. They're at 15%. How will this play in to Bitcoin's price? One to one, in a sense. I know there are other factors, but how does Bitcoin typically react to tariffs, slash, how did it? And how will their relationship move over, let's say, the next 12 months? If they're taken down, will that be good for Bitcoin's price? Will it pull back? Educate us.
So I don't think Bitcoin is correlated to tariffs sort of whatsoever, but it is correlated to equities, and equities will go up very briefly if sort of what happened when tariffs got taken off. Equities went up and then they rolled over straight away again. So it's sort of just a market reaction. But the market is now expects tariffs to stay and beyond. So I don't think Bitcoin would just react in line with equities, which would react how they've reacted. But going forward, I don't see how that reaction is going to be. It's going to be less and less in terms of reaction every time Trump makes a tariff announcement in terms of a change, unless it's something really, really drastic. But I don't think that's something for us to worry about or pay too much attention to in terms of the correlation between the tariffs. It might affect the price action on that trading day, but I don't think over like it won't affect it over weeks or months, depending, unless he goes and does these 100% on China's and stuff like that. But I don't think he's doing that.
Yeah, that makes sense. What about regarding the dollar strength and how are tariffs affecting the dollar? Because from top level, like down, when I was reading a couple of articles that we put out, dollar was getting weaker, stocks weren't moving great, Bitcoin was falling. It seemed only gold was performing. So what's the situation with the dollar right now? And was there any update on the relationship between the dollar and the yen that we were looking at a couple of weeks ago?
Yeah, so in terms of, I need to get it up. Uh, yeah, it's just range bound. Dollar yen is now 156, but um, the yen is weakening again. Just generally is weakening against the dollar because of their fiscal deficits in Japan. So that's the situation that's going on there. But traders are really aware of this now. They know that. So I wouldn't. Again, that can have its sort of gyrations, but um, ultimately the market is aware of this. It's not something. I think it was August 2024 when we've had that first yen carry trade unwind, and that was when it wasn't really looked at, or wasn't people weren't paying too much attention to it, and it really caused a puke down for risk assets. But the rebound was very quick, and again we're lucky we got that one as well in terms of realizing that it was just what it was. It was a yen carry trade unwind. Um, the dollar also, so the yen is weakening against the dollar because of the sort of terrible fiscal deficits in Japan. In terms of the dollar is also just generally weakening. Other economies are probably done cutting rates and potentially hiking rates. The US is going to be lowering rates, or it looks like the next move or set of moves is going to be for lower rates. So again, that all goes towards dollar weakness. So the general trend, again, zoomed out trend, is going to be dollar weakness. But dollar weakness doesn't necessarily always mean positive for risk assets.
Mhm.
So it's something that I don't pay a ton of attention to the dollar weakness now, to be particularly honest. But you are then looking more at the equity indexes and then bond yields. And I think what you're seeing is, especially at like front end bond yields, they're really starting to like look like they want to break down. I think the 2 year now is back to 3.44%, and the lows recently were 3.38. So I think if we get a break below 3.4, 3.38, and the 2 year is what the Fed looks at as to whether they should be cutting rates or not cutting rates, you know. So I think the 2 year is really the one to watch rather than the dollar.
That makes a lot of sense. If we circle back to crypto specifically and we take a look at Bitcoin ETF, we're still seeing outflows, right? And a question I have for you is we saw this run off of the news yesterday where we went from like 63 to 69 and we pulled back down. Tom, who is buying and who is selling right now? Who are these people? Is it the retailer? Is it the ETF stuff? Is it the DATs? Who were the people selling at 69 and who are the people who are buying at 63? Who are they?
So in terms of the ETFs, they've now you have the last 2 days were good in terms of inflows, but generally you just have still we're past the stage of huge outflows. We're now at the stage where the dominant side is still outflows, but in small size. That's where we're at right now. In terms of the general outflows from ETFs, in terms of the holders that are down in terms of their dollar value, but in terms of their actual outflow of Bitcoin, for instance, they're not down that much. They're pretty resilient, the ETF guys. What's driven price down from the mid 100K, I meant to say mid like 110s, 100 to 120. What's driven price down from there into the 60s has been the long-term holders selling that down their size. And there were some really big sellers. Like in Q4, it was like Galaxy were leaking out that they were taking someone out for $9 billion or something like that. I think it was at the time, which I believe was 9,000 or 90,000 coins. It was a ton. So that's what we were up against. And the ETFs did relatively well at that time, to be honest, to absorb a decent amount of it. But it then just sort of they weren't able to absorb it anymore, and prices really came down. Those long-term holders now are not selling like they were. They're actually in a small accumulation mode, but it's not aggressive at all or anything like that. And you want to start to see that get aggressive first. But ultimately, it seems that they're done with their selling now, which is the first stage of like what you'd want to see in the bear markets of like, okay, we're going to start this turnaround. And again, this is why I think the price pain part is done. And we're now at the time pain part, and we should see that accumulate. So that selling is no longer selling in big size, and it's no longer selling in small size. It's then gone neutral, and now we're getting small accumulation. We want to see that accumulation start to increase and become more significant. That can then really take the market higher. But essentially, if you want to look at the selling over this last 3-4 months, it's not Jane Street, it's not whoever else conspiracy you want to come up with. It's just long-term holders. Like, that's what it was. If you just look directly at the on-chain data, long-term holders are the reason.
And what about the buyers?
Buyers now,
Yeah, like who are the people who are buying up yesterday?
ETFs. Again,
Just ETFs, yeah.
long-term holders, but small amounts. And again, that's why if the ETFs were really aggressive, and the ETF flows were quite good yesterday, to be honest, but if the ETFs were really aggressive and long-term holders were aggressively in accumulation mode in terms of their sizing, and they're not at the moment, they're in accumulation mode, but very small sizing. If they were in aggressive accumulation mode, you'd start to see prices really climb, and get a sustainable breakout that then pushes up it. And it's sort of this like slow climbing higher. But I think we're just range bound at the moment. So I think you're going to get a mix of stuff, but it's mostly going to be you've got the ETFs picking up coins, and you get long-term holders also picking up coins just in small size. But again, we're past that long-term holders selling in big size, ETFs selling in decent size. So I'd say that's the positive. So if you want to look for the positive looking out, that's it. We're past the turn now. Price pain has happened. We're in the consolidation part. Whether that takes 1 month or it takes another 4 or 5, I don't think it takes 4 or 5, but I also don't think it takes 1. I think it's somewhere in between. But giving myself a bit of room there. But yeah, I think that's what we're in that choppy part for 1 to 5 months.
No, that makes a lot of sense. I have a little game to play with you, Tom. So we mentioned the next 3 to 5 months. I want to throw a couple of events in your direction
Okay.
over the next couple of months, and I want to get your take on how you think they play out, along with the bullish and bearish outcomes. So let's take a look at the moment Powell is out of office. Tell me about that event. Good, bad, bullish, bearish, what are the possibilities? Powell's exit.
Nothing. I think just completely nothing. The
Zero.
market will be looking at Warsh before Warsh is even in, and a month before Warsh gets in, whatever Powell says, no one will care about.
Okay. Trump's
Unless it's
visit
crazy.
to. Yeah, for sure. Well, didn't you mention a lot of it's going to depend on whether he stays on the board or whether he
Yeah,
fully exits?
yeah. There's that as well. I think he will. I think he'll step down. Like it's just if he doesn't step down, it's because he's just giving a middle finger to Trump, basically. And Trump will just cause him, make his life complete hell. So not that he hasn't sort of already done that, but he'll step down, and I think that decision will sort of come when the Department of Justice. I think they need to drop the subpoenas against Powell and the Fed.
Yeah. Okay. No, interesting. Interesting. What you mentioned how Kevin Warsh has been nominated, but he hasn't been like it's not finalized.
It's not
What's the
approved, no.
process of that happening?
So he has to be voted in. What is it? I can't remember how many there are. I think there's 13. It needs to be voted in by the Senate, and there's 13 senators, and there's Republicans have the majority, but Tom Tillis, I believe, he's the one that isn't up for re-election, so he doesn't care if he takes the backlash. He's the one that said, we will not vote on this or make approval, which basically puts you then at deadlock. And he's basically put the pressure back on Trump to get the situation with Powell resolved, not before Walsh gets voted in, but before anyone gets voted in. They won't consider anyone until the situation with Powell is resolved. So that's a good thing. That puts pressure on Trump to either drop this now or just to do something to get this resolved rather than have this crap, because that's what it is, just crap overhanging. You don't want the president of a country, I know it's not him, it's Department of Justice, but you don't want the president of a country subpoenaing the guy who's in charge of the independent Federal Reserve that sets the cost of borrowing money. But you just don't want that. So I think the senator is right to have done that.
Oh, that makes sense. I think the last one I had noted down was where's it gone? The next Fed meeting. Is that going to be a relevant one? There's a dot plot update.
Yes.
Yeah,
Yeah,
tell us about that.
there's all that. So I think you're going to get a more hawkish, like just in terms of the dot plot, more hawkish dot plot. But that doesn't mean, like for instance, Moran will pull his number of cuts in. He might be at 3 to 4 cuts rather than like 5. But I still think you're going to see the Fed be priced for 2 cuts this year. So I don't think that will really change. So I'm not really too worried about that. And I think you'll see the dovish members be looking for three cuts this year. So I don't think it will really change too much. I think the Fed are at this point where they've been on hold for the last, what is it, 3 months or whatever it is. It's about 3 months. So they've been on hold and they've done their period of holding that they need to do. Again, it's probably got another 3 months to go. But the situation they've laid out it has sort of played out quite well. So there's no real need to update the dot plot aggressively for more cuts or really hawkishly for less cuts. I think it's as they had in the last dot plot.
Yeah, that makes sense. Okay, Tom. I guess one final question on macro before I open the floor. I've been collecting questions.
Cool.
What is the market getting most wrong right now?
I would say I say like the M2 liquidity stuff, in all honesty, and saying that I would say there's nothing that sticks out to me in terms of the like any charts or trades that would be wrong or getting wrong. I think everything is priced about right. I'm surprised equities are where they are. I do think they will roll over like more aggressively. And they do look very tapped out. To be honest, you've not had much upside in the last sort of 4. I think equities have done nothing since late October. I mean, the price of the S&P was at 6,900 in late October. We're now late February, and it's at 6,870. It's pretty crap. In terms of just general performance, it's sat still for 5-6 months or whatever that is. So I think that I would say that's due to roll over, and gold is probably due to go higher. And the US 2-year is probably due to come down to 3.25, somewhere in there, 3.2 to 3.3. But yeah, just metrics wise, because I see this, there's loads of stuff on Twitter that like would wind me up, for instance. But that's the one on Twitter that does sort of wind me up. And I don't know if I should say, but like others talk about the ISM and the business cycle and all that. Bitcoin does not work off a business cycle; it works off a liquidity cycle. So it's not to do with the business cycle. If you, for instance, Korea at the moment, the economy is not doing well. They're very close to recession, but the market is roaring. So then you look at like what I'm trying to say is strong financial markets don't always mean strong economies. Usually, you have strong financial markets coming out the back of a weak economy. That liquidity from the strong financial markets gets put into the real world, and then you have a strong real economy. I think that's where we're at. We've had the strong financial market, we're now moving into a more of a strong economy over the next sort of like year or two, but it just depends on the labor market and this bit of hiring. Because everyone is so much more productive with AI that the hiring is just not needed like it was. Um, so yeah, that's how I'd answer that. I probably didn't answer that too directly, but I've just answered that with what came to mind.
Okay, no, makes sense. I know exactly what you're referring to. Um, No, that's great, Tom. Tom, I wanted to talk to you a little bit about equities. I guess it stems from this. We saw how muted the market was with Nvidia, even
Yeah.
though things came in higher than expectations. Is this simply because, like you said, people are just topped out when it comes to equities? The narrative almost overpriced the the great performance over the last, let's say, 6 to 9 months, and we're just at the stage where there's nothing they could have done numbers wise for people to care more. Is that what
Well,
it is?
I
Go
think it's
ahead.
about how sustainable it is. And you say, like you said just then in the question, how well the AI trade, big, mega cap tech has done over the last sort of probably 9 to 12 months rather than 6 to 9 months. But the AI trade has done phenomenally over the last 9 to 12 months. But it's sat still for the last 3 months. And I think that's because something was extremely valuable in terms of what it can bring. Um, doesn't mean it's priced appropriately. So it just could be the case that valuations have run a little bit too far here and just need a breather for 3 to 6 months. Maybe with 3 months into that, we've had the consolidation, and then we need a bit of a pullback for 3 months, and then a consolidation for a month or two, and then you can start going higher. I think that's what it is. And you're seeing this move away from AI into real world assets, which is again just only helped gold and other sort of like precious metals, for instance. Um, that's how I would see that.
Okay, it's interesting. Are there parallels between this kind of AI bubble and what we saw with the dot-com bubble? Or no?
Yes,
This is
yeah,
different.
definitely parallels, but it is different as well. These companies are making money, like real money. Nvidia, for instance, is really really printing. So again, it's just a case of where in the .com bubble, and again, I was like 4 when that happened, 5 when that happened. So I have to look back at time without like actually experiencing it myself. I can look back at the charts, the data, look back at what the companies. The companies weren't making money. They were just ideas. You know, it was similar to when on earnings calls last year, companies were just putting AI. They're using AI in their earnings calls. Back then it was they would put .com. That was what the thing was, but they weren't really generating money. The AI companies are really generating money, even though like a lot of them aren't profitable, or a good chunk of them aren't profitable. They're using free cash flow to go and fund this, and now we're in the next phase of it where companies are now raising debt to fund it rather than using free cash flow. So I think people or investors are just looking at this saying, how much more juice is there left to squeeze on this? And that's why you're seeing this rotation away from the big AI names, the big cap tech companies, and you're seeing a rotation into people trying to find returns elsewhere that might not be susceptible to a 30% drawdown.
Yeah, no, very interesting. You mentioned like manufacturing, like costs, etc. We've spoken about retail sales before. We're looking at quarterly earnings for some of these companies. I have kind of two different directions I want to take this conversation, but I'll start with this. So we have to look at how AI is actually impacting the world, right? So you have a company like Nvidia, which is releasing record-breaking revenue numbers, but these companies are doing incredible, but they're not necessarily hiring more people and paying
No.
more salaries. So typically in the past, you would see companies perform better and the job market looks better. and people are making more money and people have more disposable income. And it's almost like a type of feedback loop where, hey, people, the better the labor market, the more people are spending. And it just made sense. But we're at a tipping point where these companies can be performing better than ever and actually be more profitable than ever. And they're making money from one another, with Nvidia selling its chips, etc.
Yeah.
But it's not trickling down to the average person working for these companies, in one sense. And maybe it benefits the investor if your paycheck directly goes into the S&P 500. Sure, your net worth may go up, but this seems like it's changing. It's a complete paradigm shift between the past and what AI is actually doing to the job market.
Well, that's the big question everyone's asking: is this good for the job market or bad for the job market? And this is the question. Like no one really knows. Um, these companies, for instance, like you look at Meta, for instance, they're paying their top guys like 100 million. So you don't need more people. You don't need more labor. You just need the creme de la creme top talent essentially. So and that those are the guys that are or women that are making the money. And it's not a case of like what it was in prior decades where you build a company, you want to grow, so you need to recruit more. Um, these workers are just they're just much more productive. And with AI is not going backwards; it's only getting better. And with it getting better and better, there's no reason why the productivity can't keep increasing. So again, there's just less reason to hire again.
Yeah, yeah, it's like it's going to be interesting how the government and how these companies approach it. It's, let's say you want to increase salaries. It's like, okay, well, why would a company not just go out like McDonald's does and create those little
Yeah,
machines where you can order? It's a tricky one. So I'm struggling to kind of picture how this goes for the investor. How does an investor best position themselves to actually capitalize not on the AI narrative trade, but the actual future of like the economy, the investing landscape? Like what companies and sector are those to bet on? Because it does seem like, yeah, sure, you can just keep telling people to DCA into the S&P 500, when in reality, they're not even really diversified. They're just buying more and more Nvidia as it grows.
yeah,
So I just feel like the landscape for investors is changing at a rapid rate, but people don't know why, and they don't even know that they are doing this. But it seems like we may get to an interesting tipping point where the whole world is changing from an investing point of view too.
yeah. It's again that's a hard one to answer in terms of where do you, I don't know. AI is the hot trend at the moment. So in terms of like investing in AI now, you're and it sort of goes with what I've been saying about Nvidia. It looks like how much juice is left to squeeze on this trade at this current point in time. It's hard to really say. I think you're best off looking at other sectors that might be, the hot thing in 18 to 30 months time. It could be something like quantum, for instance. It could be along those lines rather than AI. Um, so that would probably be my answer back to that. I don't know what would be attractive on the. I think a lot of people are moving out of Nvidia into AMD and other companies like that rather than looking for what is going to be the hot thing in 12 to 30 months time. And I think you're best if you're an investor, you're best off going down that approach and trying to like anticipate where the world is going to be in 12, 18, 24, whatever months time, rather than buying in today and looking to cash next week.
Yeah, absolutely. It'll be interesting. I actually think you're going to see even more of a divide between Nvidia and some of these other quote unquote
Yeah,
contenders, because I think in the AI world, if you are at the top, if you're in pole position, I don't think AI is really it gives the illusion that everyone else can now catch up because they have access to the same materials. But I actually don't believe that. I think
no,
that you're going to see even more of a spread between those in pole position
gap widen.
and
Yeah.
everyone else trying to get the gap will only widen, which I think would change the whole game. I think in each sector or industry, you're just going to keep seeing bigger and bigger separation. And it is interesting because it does completely change the way you look at the stock market, because no longer are you really betting on a wide variety basket of goods across a whole economy. You're almost, in a sense, almost stock picking. If everything is
Yeah,
relying on AI, the whole infrastructure of every single company that manages to be in the S&P 500 slash, make up a huge percentage of it. One thing going wrong, and it just changes everything, which I think in a way does make you really think like, okay, well that's why stuff like Bitcoin and gold are attractive because
Yeah.
they are very different, right? They're not just some other company in a particular sector.
This is a personal view. If Bitcoin can solve the quantum problem in terms of just putting a path forward that's like sort of unanimously agreed upon about how they're going to push forward, someone needs to. Again, all the companies are starting to invest a little bit in this to figuring it out, but someone needs to take the lead on this. It should be a sailor or something like that. Um, but and there's a few people that are really speaking out about it that are like very very smart people, and Bitcoin will absolutely fly. I think once this problem is removed, I really think it will absolutely fly. But this year there needs to be a solution for that quantum problem. If you want to hedge that, you can try to invest in quantum stocks, but again, they're different. The quantum stocks, they target different things rather than Nvidia, AMD, etc., are all trying to do the same thing. The quantum stocks do target different solutions and different ways of going to about monetizing. But that might be a hedge. But hedge against Bitcoin, for instance, if you want to protect your Bitcoin investment, say the quantum thing does happen. I don't think it will. I think the network Bitcoiners, whatever, will get in front of it before it becomes a problem. But at this moment in time, we're sort of behind that path. So that's why there's these like worries or whatever about it. But once that is removed, I think Bitcoin will the catch up trade will be phenomenal.
Yeah, absolutely. I see that completely also. I think the quantum threat, we've spoken about this multiple times, it is real in a sense, but
Hmm.
it's definitely more of a narrative thing, which I think is great as it keeps things down longer. And I think inevitably when a solution to a non-existent problem almost is presented, it just means the bounce back will be so much harder. And I do think, you've mentioned Michael Saylor a couple of times as being one of those guys who should front run the initiative. And I think he will. I also think you have to look at the ETF providers themselves. I'm not the most technical guy, but I did have a conversation with a bro, and a bro pretty much said, look, the solution to this quantum threat is fork, like a fork, right?
Yeah,
Like you probably saw with Bitcoin and Bitcoin Cash, but basically there needs to be to copy the blockchain, and then people need to decide which one they want to continue focusing on. Is it the one with the upgrades and the changes, or is it the original? And I do think ultimately now, because you've got this kind of consolidation of control, I think it's like there's like 160 treasury companies around the world who hold nearly 9% of the Bitcoin supply. I'm not sure what percentage of the Bitcoin supply is held in ETFs. I think Michael Saylor strategy own a huge percentage. When these guys collectively come together and decide like, okay, look, we're going to do a fork basically, and this is what we're doing. It's as simple as that. I don't think the average retail guy who holds 0.25 Bitcoin in his Bitcoin wallet is really going to have a say in the matter. It's just going to happen. And I could be getting this wrong, but a bro said something to the effect of, hey, when you actually look at some of these ETF filings, they're not specifically Bitcoin in its current form. It's like BTC products in a
yeah,
sense. So they've almost already done this in advance. And I think that's why some of these big players like the BlackRocks and the Larry Finks and Michael Saylor, they don't seem to be running around panicking about it. They don't seem to be bothering at all. Probably because they already understand like this is an obvious thing we have to combat. But maybe 2026 isn't the time they need to tackle it, or maybe it's just going to be something that syncs up when the market starts to run. We've spoken about meme coins 1,000 times with members who, are upset that, we as a crypto company aren't really pushing the meme coin narrative, but we understand it's not the time anyway, right? If
yeah,
we were to go and try and push the meme coin narrative, and or if Michael Saylor and Larry Fink were trying to push like, no, we can solve quantum, it's going to fall on deaf's ears to an extent because people just aren't willing to go risk on anyway. Whereas when people are a lot more risk on and they're willing to take a punt, and then the narrative lines up with, hey, this quantum thing, we already got it sorted, right? I think it just makes for a much bigger
I
push. But it
think
depends if people get shaken out beforehand.
I think it's harder than that. I think the quantum problem is that it's definitely more difficult than that. There's so many issues with doing a fork because the Bitcoiners at heart don't want to fork to change over. There's this real universal sort of mentality of to not change the code. So I think, you know, yes, you do have to go and do the fork. That is the way to go, or you just start quantum proofing. Um, the current network. But then what happens to people that are in prison and can't do the upgrade whilst they're in prison, and then a quantum machine comes about in 3 years' time? What happens to Satoshi's coins? That's 4 million coins. There's 4 million coins that might then come to the market and essentially be market dumped. Um, I really think it's a real problem. It needs to be not resolved this year, but it needs to have an agreement of how it's going to be resolved. It needs to go down that fork route, yes. But I think actually getting it done will be more difficult than what we think.
Yeah, it's interesting. You could be right. I just think the people who are very anti-establishment, sovereign individual, and care about Bitcoin from being completely anonymous and peer-to-peer and F the middleman, these guys aren't the ones who are going to make any real decision. It's going to be these big players who, are controlling the ETF and these DATs, etc. And where there's money to be made, like I feel deals will be made. And I just think there's too much on the table for these big players who actually have an impact, for them not to get in a room and come to a consensus. And when you hear some of these guys speak, I think sometimes we take it for granted because we see them bull posting basically Bitcoin on Twitter. I think we take for granted just how serious these people are. If you ever sit
Yeah,
down and watch Michael Saylor talk outside of a newsroom, the guy is a genius.
yeah,
Whatever you think of BlackRock and people like Larry Fink, they do not get involved in something lightly. This isn't a little trade for them, right? It's a serious play. They're not thinking in 2 3 year time horizons. As soon as they've been stuck in the game 10 years ago, these guys were thinking about the quantum threat. I remember when I first got involved in Bitcoin in like 2016. I sat down with a couple of people, Assad, Sid, etc., and we were walking actually through the DIFC, and we were saying Bitcoin was nearly trading at 20K at the time. I think 2017 maybe is when it had
yeah,
that big run. And we were like, well, computers, man, computers are picking up. How long is this thing going to be around? We talked about quantum back then, as it was FUD around that time, and it was at 20K. And we couldn't have even fathomed a world where you have things like ChatGPT and Claude and Anthropic and these
yeah,
things back then. If I saw Claude back then, I would have thought this is a quantum computer,
yeah.
right? Like this sounds crazy. So yeah, it'll be interesting. We do have a thorough piece on the quantum threat, so maybe we can tag this later on in the description. But yeah, man, I think we covered a lot. Is there anything else macro related, on-chain related, mechanics related, news related that you feel is important we address?
No, I think my only message would be that I think we're in for several months of chop, and to zoom out when you're looking at, like, yesterday a few people messaged me, like, and I sensed a lot of FOMO yesterday, but that sort of made me chill a little bit as well, because obviously you sense that others are feeling that or whatever. I would say just don't get taken in by a single day or even week's price action. Wait until all the underlying metrics are changing and the picture drastically improves, and look to take that DCA approach in the value zones, and just every time it's in that sort of zone and you have a bad day, -2%, -4%, -5%, whatever, DCA. That's the approach I would sort of take myself and
Yeah,
advocate
makes
for.
complete sense. I agree. And I got to give it to you. You did rotate my mindset a little bit. I've always been the guy who is like, no, I'm DCA. I'm not going to touch it. We just leave it forever. But you've done so well as of late that I have been following your playbook, and it's going well so far. So yeah, kudos, kudos. What is Tom's cost basis level? What's Tom's average entry throughout time?
I have no clue. I don't have a stack that I would like. Oh, I refuse to sell this amount. Blah blah blah. I don't work like that. I just um if I think I should sell it. I don't mind selling it all. Like I like there's points in time where I would sell it all, and there's points of time where I'd be completely all in, borrowed a little bit. There's so there's not like I don't have like an average. I did well in 2022. I had my average cost at like I think I was at like 17.8, but I was very lucky. I sort of like was DCing more into my portfolio and I got a bit more money out. But even then, it was very obvious because of price being below realized price. It was in like the 21, 22K. And then you had Bitcoin going to like 18K. It was 15%, 20% below realized price. So they were like screaming out to me kind of metrics. So my average price back then for that cycle was 17.8. So I was that was very good. But again, sort of lucky as well. This time now, whatever it ends up being, I think if you can get anywhere in the sort of anything below 60K, I think is great in terms of an average cost basis.
Yeah, that makes sense. Okay, Tom, thank you very much. Appreciate it. Thank you for everyone who was watching. If you want more of this type of content, then check out Crypto Pro. If you want to work directly with me and Tom, click the link in the description, check out the inner circle. And yeah, Joms, Mr. Producer, thank you very much. You can end the stream. And yeah, thank you everyone for listening. Cool.